Good evening, everyone, and welcome to tonight's webinar on youth money skills. My name is Assemblymember Dr. Akilah Weber, and I represent you in the California State Assembly. My district, the 79th Assembly District, currently includes the cities of La Mesa, Lemon Grove, Bonita, National City, Chula Vista, and parts of San Diego. I want to extend my appreciation to everyone who registered and made the time to be here this evening. And I also want to give a very special thank you to our partners at USE Credit Union, who will be giving tonight's presentation. Financial literacy is the cornerstone of financial success in today's society. Knowing how to build your credit, make a budget, and stick to it are valuable lessons that you don't get taught in the classroom. That's why I thought it was so very important to provide this space to offer guidance and support as you navigate your finances. There are so many reasons why financial wellness is so important, and some of those include lowering your stress levels, offers day-to-day and month-to-month control over your finances. It allows you to track and meet your financial goals, and it offers financial freedom to make choices that allow you to enjoy your life. At a minimum, financial wellness helps to increase financial knowledge to help you make informed and smart decisions about your money. This financial knowledge will help you create and foster a healthy and happy and somewhat stress-free relationship with your finances. So congratulations on taking this step toward your financial wellness. And now I'd like to introduce Debbie Etchings of the USE Credit Union. Enjoy the presentation and please take lots of notes. Thank you.
Thank you so much, Dr. Weber. We really appreciate it. And thank you for your dedication to financial education and wellness. This is where it gets started, is when you're a youth. So before we get started, I wanted to share with you that there is a Q&A portion of the Zoom that if you have any questions, please feel free to use that. And you can ask those questions, and then we'll go over those at the end of today's session. And then we'll also have some information available if you want to reach out to me personally, if you have some questions, and you're free to, we'd love for you to do that at any time. So thank you for joining us this afternoon. We are thrilled to share with you, and we hope that today's session is the first step in preparing for your financial success. I really don't need to say anything more. Dr. Weber did such an incredible introduction. She covered everything. So, I hope I can just fill in some of the pieces, having worked for financial institutions for many, many years now. It doesn't matter what age you are. Money skills are so important. I wish someone had shared this information with me when I was in school. It would have saved me so much time and money had I had an understanding of how finances worked, how important they are to our financial future. Here's a look at what we will cover today. But we're going to cover the basics of money management, how to save and prepare for typical future bills and goals, why and how to use a checking and savings account, the wise use of credit, as well as buying your first car. These are all exciting things, but we need to know something about them before we get there. And the basics of investing for your future. Our hope is that when we finish today, you will have the beginning understanding of finances and a good roadmap to success. So, what is so important about setting goals? It is the most important thing when it comes to your financial future. Right now, your goal may be just to get through this Zoom and get to your homework and get that done, or do something fun. However, as you continue with your schooling and eventually go out into the workplace, it is so important to have goals set for yourself. There's a big difference between dreams and goals. So goals are specific and measurable. The goal should be maybe graduate in 2023. That could be your current goal. Dreams are vague. Like, I want to be a millionaire, which is a great dream. Don't get me wrong. That's great. But needs to be more specific and measurable. A good way to remember what goals are and how you should determine what they are is to use the SMART goal method. So what that is, it is specific, it's measurable, it's attainable, it's relevant, and then it's time bound. So these are really important things when you're setting your goal. So what are goal timeframes? You have your short-term goals, and those are achievable in under a year, or maybe as soon as this webinar is over, right? Your midterm goals are achievable in 1 to 5 years. Your long-term goals are achievable in more than 5 years. Think about what you want to do when you start making money. How much will you need for your goals? And when do you want to achieve those goals? Right now, you are probably more focused on those short-term goals at this point in your life. Remember, you want to be realistic and flexible and not give up. You may have to adjust them as you go along because life changes and your goals and direction changes, but you still need to attain the goal. If you will attain it, if you stay focused and learn good habits, because that's key. So, budgeting, the B word. You may have heard adults around you say, that isn't in our budget. So what does that mean? So budgeting is very important. First, if you're like me, budgeting was a very negative, restrictive sounding word. I didn't like the sound of it at all. But I did like the sound of calling it a spending plan, because ultimately that's what it is, you have to make a plan as to what you can spend and what you can't spend. And you will probably need to have a budget and a spending plan now and the rest of your life. It's really important. And first rule of a spending plan is you never want your expenses to be more than your income. Now, I know that sounds so elementary, right? Of course you don't. But it makes lots of sense. However, it may be easier said than done. You can develop a budget or a spending plan with just a simple piece of paper as you get started. And then later, as you have a job and your income is consistent, you may want to use a computer application. Use your goals to help establish your spending plan, because that start. It's like a blueprint to building that house. Okay, so now that we've got our budget figured out and our spending plan, now let's talk about income. Now, it's kind of one of those things like, well, I don't really have income, but you don't realize you may have some. Your sources of income right now may be allowance, babysitting, dog walking, chores, maybe mowing the lawn, a part-time job, and then at some point, a full-time job. And some of you may already have a part-time or full-time job. When you get your first paycheck, now let me tell you something, because now you're figuring this out when you're doing your budget. You will see you made what is called is your gross. And then you see what you actually get, which is your net, which is after taxes. I remember the first check I received. I couldn't believe the difference between the net, which is what I got, and the gross, which was before taxes. It can be a bit shocking on your first check. And you will always want to use that net income when you're figuring out in your spending plan. Don't use that gross, because that's money you don't have right out of the gate, right? And so make sure you are putting down what you're actually taking home. So your spending plan that we talked about, if you're making your first spending plan, it is important to look at what you're spending money on. Starting out on your spending plan, you may right now just be putting gas in your car, or maybe helping the family with needs, or even some school expenses. As your situation changes, you will need to make changes to your spending plan. If you're working part-time or just doing random jobs, it's easy to spend that money as it comes in, that cash or whatever, and bam, you're spending it. Maybe it's you want to spend it on that latest, electronic device that is so cool. Now is the time to learn what is the difference between needs and wants. Okay, it's a good example of that. So you can kind of get an understanding of that is uh, we all need to eat, right? That's a need. We need to eat. However, you don't necessarily need to eat out all the time. So that's the difference between a need and a want. I personally want to eat out all the time because I don't want to fix dinner. So, but you have to figure that out when you're doing your budget. How do I work this in so that my need is to eat, so maybe I eat at home or that, or do I get to spend some time eating out? You can always put that in that budget plan. You want maybe that latest app from the Apple, App Store. Maybe just need to choose one that's free, and outweigh that will help with your budget too. So preparing for the future. Now, we're like, okay, now I've got this job, and now I'm going to move out, right? And so when you're becoming independent, that comes with a lot of expenses and responsibilities that you've never had before. Moving out costs can include anything from maybe a moving van, depending on where you're moving, which typically doesn't happen the first time you move, unless you have family that's donated a ton of furniture to you. Most, it is a bed, a TV, and your game system and clothes. Enlist a friend to help you so you can save on the cost of a moving van, and then buy them pizza for helping you, much cheaper than having a company move you. I remember when I first moved out on my own, I went to the Del Mar Fair and tossed dimes. Now, this might age me, I don't know. I tossed dimes into drinking glasses so I could have some for my apartment. So I went home that night with I think I had 10 glasses, 7-Up, Coca-Cola. They were all weird, things on them. But I was so excited because I had something for my apartment. So, things like that, maybe 10 cents for a glass versus maybe $1, save me some money. There's also your first and last month's rent, various security deposits, and furniture and appliances that you have to purchase that maybe family didn't give you. My mom gave me a couch. That helped. Even though it was an ugly couch, I didn't have to buy a couch. So think of it that way. Be thankful it's a couch, right? If you need a roommate so you can afford it, remember you want to choose wisely when you take on a roommate. My suggestion is that you interview them first. And I know that sounds silly, but it's really important. Make sure they can keep up their side of the rent, utilities, and food costs. You don't want to find out that, oh yeah, they want to move in with you, but they really don't have a job or they're not making that much money to help with those costs. So make sure you're looking at that before you have that person move in with you. And then household bills often will include your cable, internet, phone, garbage, gas, electric, and water. There's a lot of stuff that you're going to have to come up with. And you may want to think twice about leaving your lights on. I'm telling you that when I lived at home, I could care less. And even though my mom would say, turn off the lights, when you're paying the electrical bill, trust me, you turn off the lights. Maybe you just need to get basic cable and not that NFL package that you really want. So think of those things. These are ways that you can afford to move out on your own. So, and then you got to think of this. Besides your housing costs, you may start paying for other expenses like your cell phone. Maybe your parents paid for that before, or your gym membership. And then people often get in trouble with these expenses because they commonly require you to sign a contract, which can obligate you to make payments for years. Really think carefully about what you can afford before signing a contract. It's so important to get in the habit of paying your bills on time. If you do not pay your bills on time, you could experience late fees, collection activity, credit damage, and suspended rights to services. And I'll talk more about paying on time because it's a big one for me. So now you're out and you go, I need a vehicle. I need to buy a car. And you may not have bought a car yet, But I know we all want that fancy car with all the bells and the whistles. However, the cost, that's going to cost a lot of money. And you may not have the income source to support the payments. Your first car may be a cheap, affordable vehicle to get you to and from a job. There is always time to get that dream car. Just don't go get it out of the gate, because you're going to find yourself probably not being able to make those payments. It's critical that you know how much owning a car will cost you, because we all think, oh, it's just a payment, I can do that. But you need to know that there's more things than just a payment. Let's talk about monthly payments. Depending on whether the vehicle is new or used, economy or luxury, and the financing deal and down payment, this cost can vary significantly. So I'll give you an example. Let's say you find that perfect car. It's a $30,000 car. You financed it for 60 months, an interest rate of 6.9. And again, you're going to remember, you may see lower interest rates, but right now you may not be able to get that lower interest rate because you're a new borrower. That would cost you $640.03 a month. That's a lot of money. So think about it this way. Maybe you go a little cheaper, half that, and you get a $15,000 car financed for 60 months. With the same interest rate, that would cost you $320.02. Now, there are lower and higher interest rates available, but it will be determined by your income and your credit history. That is why you may need a co-signer, if you choose to finance your first car, and we'll go into that. And remember, you're going to have insurance. Liability insurance is required in most states. It is also a good idea to consider additional coverage, such as collision and uninsured motorist coverage. And then you have your maintenance and repairs. Even if you have a warranty, you will still be responsible for routine maintenance. And if you get an older car, used car, it may cost you more to have maintenance done on it. Then you have gas. Just getting from point A to point B can be expensive. And especially right now, we're all experiencing a little higher gas prices, right? So you may want to get a car that's going to, has better miles per gallon. Or maybe if you have somebody that you can get an electric car from, maybe that's what you have to do to save the money. So these are all things you got to think about. Depending on where you work. If you've got a full-time job and you're working somewhere where you have to pay for parking, then that's got to go in your budget too, because you got to pay for that. For me, I saved for my first car with a job I had at Foster Freeze. And I loved that car. It wasn't pretty, but it got me to my work and to school. It took me years before I upgraded to another used car. And I actually love that old car, so I miss her. We used to call her Old Betsy. So, having an old car to start out is not a bad thing. I encourage you to save for a car, and you may need to save for the down payment as well. If you're going to borrow as little as possible at the lowest rate you can qualify for. So when you are borrowing the money to buy a car, there's a lot that goes into what you can afford and what you qualify for. Those are two different things, okay? Lenders will run your credit, and if you haven't established any credit, let's say this is your first credit purchase, you will get probably the highest interest rate, or possibly you'll be even required to have a cosigner. So I talked about it earlier. What is a cosigner? A cosigner is someone who has established credit and agrees to be on the loan with you. Now, this can be a parent or relative, but remember, you need to make the payments and make them on time so it doesn't affect the cosigner's credit as well as your own. So now how are you going to make those monthly payments, right? You need a checking and a savings account. And these are accounts that you're going to use for the rest of your life. We're kind of a cashless society. And so you're going to need that debit card, all of those things to get by. And there's different types of accounts out there that you can do, but a checking account, the difference is a checking account allows you to write checks as well as have a debit card. And as you graduate and move into your next phase of your life, you will need this type of account. Until you are 18, you may not be eligible for a checking account alone. We'll need an adult on that account with you. So how do you use a checking account wisely? You keep track of what is going in as well as what is going out. And you can do this with, online banking, which is so important. If you get that checking account, make sure you sign up for online banking so you can keep track of everything. Online banking is the best thing they've ever come up with, as far as I'm concerned. That way you can check your purchases and your deposits, and you can set up those automatic payments, or you can set up that automatic deposit from your job. So it's an amazing tool that you'll want to use. And then you can also put alerts on it to let you know, where your account is, as far as you can set, like I want an alert to know when my account gets below 100, okay? And you want to always look at that when you're out and about. And savings accounts, they can be opened at any age, but they do require an adult to be on the account with you until you're 18. And savings accounts earn dividends and have an ATM-only card attached to them. So dividends are what you earn from the interest in your savings. So if you continue to let your savings grow, which is what you want to do, you'll earn interest month over month, and that's what interest or dividends. What that is that's considered compound interest. So your interest is making money on interest and your original amount. So compound interest is something that you will always want to think about as you start to get out there, invest more as you get older and as you can afford to put more into that savings account. There's also what's called a custodial account, which is where a parent or guardian of you or any young person opens this account as the primary owner. And this gives them the opportunity to save and invest for you while they retain full control of the account until you reach adulthood. So that's one that's out there too. And some parents will do that, especially if maybe grandparents have given them some money and they're not to use it till later in life. That's what they'll do with a custodial account. Everyone at some point should have a savings and a checking account. So establishing savings habits early is really important. A checking account will help you become independent and responsible. So how do we manage that checking account? It's so important. Yeah, so important to manage it. Always know what's in your account. Banking is so much easier. Like I said, now that you've got online banking and mobile banking, you can look on your phone and check. Make sure you have enough and didn't miss in that account and didn't miss something. You want to avoid bouncing checks. That means checks that you write for more than you have. And sometimes a landlord may want a check. So, we don't write checks like we used to, but you may need a check for that. And you want to keep track of your deposits and your checks and your ATM withdrawals and fees. Because if you bounce a check, the bank will not pay it, and it will cost you and the person you wrote it to costly fees, which ultimately that person you wrote it to will require you to pay those fees for their fees on their side as well as your own. And they may decide to no longer have let you use a check to pay your rent or your bills with. And then if you have online banking, you can have monthly statements, which is so great. They're uploaded electronically and it's safe, and you can go look at it anytime to see. And I challenge you to do that, because you always need to look at your statements and verify the record of transactions and make sure they are yours. Or you don't want to find out that someone has taken a double withdrawal out for something you purchased, and that does happen. I've seen it over the years. It does happen. So it's important that you are responsible for that account and you are checking it all the time. Don't just think that it's all good. It's your responsibility to look at that. Then, and if you're doing that, this will allow you to see if you made any errors in your book record keeping, or if you find some errors like the double withdrawal possibly, or if the account is being used fraudulently. You need to notify the financial institution immediately so that they can remedy that for you. So let's talk about credit. Everybody always wants to know, the difference. Well, this is ATM card and a debit card. This is not credit. So you've got to remember that. These are your funds. This is not a loan. These are your funds. And your ATM card can be used for cash withdrawals, making deposits, and transferring money, or looking at your balances. So that's what an ATM card can be used for. The debit card can be used in stores, at the ATM, automatically, things can be deducted with that debit card. They may ask you for the number for that. And so debit cards are really valuable to you to have. It's important to keep your cards in a safe place, especially if you're going to go off to college. You don't want to leave it in your dorm room sitting around where kids are coming in and out or whatever. That is really something that you want to keep in your wallet, close to you, not laying out, okay? And your card is for you. You should not be sharing your card with a friend to say, hey, can you go down to the ATM for me and get some money out and give them your PIN number? No. You're responsible for that if that person decides to take more money out of your account. So don't give that information to anybody. Keep your PIN number private and don't write it down somewhere. I've seen people write it on their cards. Do not memorize it. You do not want somebody getting a hold of your PIN number. And again, if your cards are lost or stolen, or someone else has used them without your permission, you need to contact the financial institution and get that card blocked immediately. So now we get to talk about credit cards. And this is such good information for you as you get started in life and apply for a credit card. And that's usually the first thing is a kid will say when they go into college, they'll come by the bank that we had there at SDSU and say, how do I get a credit card? Well, first off, you need to be 18 or over, and generally you need to have income. However, there is a good startup card. It's called a secured card that you can have. You don't have to have a credit history or income verification with that card. That's just basically your money that's being held. So we'll hold 130% of what you want your credit limit to be. So that's guaranteed to be able to pay off that card if there's a problem, but it allows you to start building credit with that card. And you don't have to have any credit history or income for that. Some source of income is needed to make payments, however, for this card. So you're going to have to make the payments on it, regardless of if you didn't have to pull credit. And it's real important that you do that. It's a really great way to get started using credit and not get yourself into debt right away. Because sometimes when you go away to college, there are people that will try and get you to open up credit cards to get a t-shirt, to get a water bottle, whatever. And those can be like 22, 24% interest. Those are not what you want. Where if you get a secured card, you're talking about 4.9% interest. That's something is doable, and it helps you to really start building credit. You got to think of this, a credit card, as a short-term loan. You make a purchase on your credit card and you receive a bill for it the next month. Okay. You want to look at credit as a way to build a positive history, not as a source of income. You should have the money to pay back what you purchased when the bill comes. So then people say, well, why do I need a credit card then if I had the money? Because as you start to get out in the world, you need to establish credit. And so you have to show that you are responsible, that you can be lent this money and pay it back. So think of it that way. That's what you're using that for, is to build that. The best way to pay off your balance is to pay it off in full every month. That's what you want to do. You don't want to become delinquent, and you should, because you can be charged late fees as well as damage to your credit history. It's good to keep in mind that holding on to debt by not paying off balances in full each month can be really expensive. The higher the interest rate, the longer it takes to repay it, and the costlier it becomes to you. Here's an example. You charged $500 for school books and materials, but can only afford to pay $25 a month. Okay. Well, if the APR on that credit card is 10%, and that's just kind of a guess, because there's, it'd be great if you got a 10% as your first card. It will take you 1 year and 10 months to repay. So in that is a $49 worth of interest. So, you're paying interest for all that time on that purchase of $500. So let's do it again. Let's do it if the APR, which is your interest, is 22%. It will take you 2 years, 2 months to repay. And that's going to cost you $129 in interest. That's almost a third of the original debt. Okay, credit history. This is something that's really important. And as you start to, establish credit, you're going to want to keep track of this. What you'll see is your credit score is what you'll hear people talk about. And that is really factors into your ability to get loans as well as jobs, because they will pull your credit history a lot of times, and even renting an apartment. So how you treat your credit cards and other types of credit matters. And your credit history will follow you for a long time. There are 3 credit bureaus that we show right here. We have Equifax, Experian, and TransUnion. And these are all ones, this is what you'll hear people say, your FICO score. That's the Fair Isaac Company. So that's what makes up, these 3 make up Fair Isaac Company. Credit scores look like, you're going to look at 300 to about 850. Now, each one of these is a little different. However, they're very similar. But remember, in this case, you want the higher score. You want to be closer to 850 than you want to be at 300. So you're trying to build that score up so it gets up there. And what they do is they use this as a scoring system to determine your score. And there are 5 main ones that they use. And this, if you don't hear anything else today, listen to this. This is so important. 15% of what they base your credit score on is how long the accounts have been opened. Okay. That means how long have you had that credit card? Did you just get it? Did you get it on Friday? Have you had it for a couple of years? Then 35% of what they base it on, which is the highest amount that they of all that they base it on, is late payments. Remember, I talked to you about that earlier. Lates are so critical. You need to make sure you're not being late on paying your bills. Set them up with an automatic payment out of that great checking account you opened so that you're never late, ever, because they really look at that. So that's 35%. That's your highest amount. Then there's 30% is how much you actually owe on 1 card, 2 cards, 3 cards. So that's 30%. 10% is the type of credit used. If it's all credit cards, then that's going to factor into where your credit score lands. And then new credit. If you're constantly opening up new credit. So let's say, as an example, you're at Ross and Ross tells you you can get 10% off if you open a credit card. Don't do it, because it really affects your score. You don't need those types. You don't need those department store cards. Just go with a basic MasterCard, Visa, and be done with it. Okay. And then you really want to look at, how you use them, because you don't want to go into collections and you certainly don't want to get into bankruptcies down the road. So once you start to develop credit, it's important to check your credit report yearly. And this is free to you and will help you to monitor for accuracies as well as errors. So at that annualcreditreport.com, you can go to that every year and look at your credit and see where you are and make sure that everything looks right and nobody's been using your information to open up accounts. So when the opportunity arises to look for a credit card, there's some things you need to think about. Low APR, which is the low interest rate, that's what you want. How long is the grace period? And then low cash advance fees. My feeling on this is you don't want to use your card for a cash advance. That's what we talked about earlier as using it as income. It is not income. It's not for income purposes. But if you do use that, your cost for it is going to be a lot higher. So you want to look at those because you're kind of interviewing these card companies to find out what looks best for you. You don't want an annual fee, your low penalty fees, and no inactivity fees because they can charge you that too. So what would happen with those low penalty fees if, let's say, you pay after the due date, which is what most people are thinking, okay, what does that mean? Or you go over your credit limit. Those are some things where you could get some more fees. You should manage your account so that neither of those occurs and look for low penalty fees just in case. So credit cards, as we get into the types there are out there, authorized user, if you're an authorized user, you are able to use the credit card, not responsible for making payments. The payment is required by the primary user. You're just an authorized user and they've given you permission to use their card and fill out paperwork to do that. And so that one you have to be really careful about because you probably need to know the person pretty well. They probably need to know more about you than you need to know about them. Then there's a cosigner. If you're a cosigner, both you and the other account holder are responsible for making payments. So it's similar to the vehicle we talked about when you're buying. This does not mean that you cannot designate one of you to make the payment. It just means that if the payment is not made, the creditor can legally come after either of you for the money. Okay? And the individual, that's kind of what the name implies. It's yours. You're responsible for everything on it. So that's an individual. And again, if you are under 18, you are only permitted to be an authorized user on a credit card. If you are over 18 and under 21, you will need a cosigner or verifiable income to get that credit card. And once you're over 18, also you could do that card we talked about, the secured card. So let's summarize. Never charge more than you can repay by the bill's due date. Get in the habit of that early on. It's so important. You'll be so much happier if you did. If you cannot pay off the whole bill, at least pay more than the minimum required on that payment to avoid stretching debt out for too long and paying a lot of finance charges. And then pay on time. Oh, please pay on time. You want to avoid fees and you want to keep that credit history spotless. And then limit the number of open cards. Like I said, you don't need Ross and Home Goods and all these different ones. Just get one basic card to use. And that way you don't get yourself in trouble. And then again, keep your cards private. Never share them with the information, and keep your account information, your statements and all that where others can't view them. So now is the best time to learn as much as you can about finances. Seek additional information and be prepared for when the time comes that you are ready to open a checking account and apply for a loan. Listen, you're going to make mistakes. We all do. And especially as you're venturing into financial independence. But errors are best made on a small scale, and you need to learn from them. That's the key, learning from them. The more knowledge you gain now, the more successful you will be when the time comes. Remember to start thinking about your goals and write them down. Make a plan, even now, about what is a necessity and what is not. If you get in the habit of doing this now, it will get you on the path for success when you have income coming in and a budget planned. Remember, finances are something you will deal with for the rest of your life. If you get started right now, it's going to be good. You want to get started on the right foot because it's going to save you a lot of headache down the road. So that's it. Do we have any questions, Danielle?
No, Debbie, thank you so much.
Let's see. Okay, perfect. I was just making sure I didn't see any on my side. But I'm glad that you joined us tonight. Thank you so much. Thank you to Dr. Weber and her team for offering this financial education opportunity. We hope you'll reach out to us if you have any questions. Have an incredible evening. Thank you so much. Bye.